Okay guys, so a bank statement loan is a specialty loan that is used for a self-employed borrower. Self-employed borrowers have a little bit of a tougher time to qualify for a loan. It's nothing like it's their fault or anything, but they do have to show that they've been working and had that business or been a 1099 income earner for at least 2 years. And then they also have to, on their tax returns every year, they got to write off their expenses. And these are things that people that are W-2 employees that make a solid, consistent, straight wage every month don't have to worry about when they're getting their income qualified. They just get qualified for the income that they're making every month. None of these extra rules around it like with a self-employed borrower. I literally saw an example not long ago where someone was making $230,000 a year roughly in gross sales. Then on their tax returns, they had to write off $90K in expenses and $70,000 a year in depreciation. They now have just $70,000 in income a year. Well, with these bank statement loans, they allow you to not have to take away that deduction for depreciation. Okay, so these bank statement loans, they don't look at somebody's tax returns. Okay, those tax returns that show depreciation of their business assets is going to take a big chunk away of their income and what they're able to qualify for. So like in this case with the 230 gross sales, 90K expenses, 70K depreciation, if you're using a bank statement loan, you don't have to subtract the depreciation away. So you're gonna end up with that borrower having $140,000 a month in income versus $70,000 a month in income if they were using a regular, traditional, conventional conforming Fannie Mae, Freddie Mac loan. So the way these bank statement loans work is instead of taking your tax returns to determine your income, we look at either a 12-month or a 24-month history of your business bank accounts. When we look into that bank statement, we take an average of your gross deposits over a 12-month period. So they use that as your monthly income, but then they also use an average of expenses that you have coming out of your account every month. So it's deposits minus expenses to equal your monthly income. Then after that, they then look at your credit report and see what other minimum monthly payments you have to make on your cars, student loans or credit cards to then get a true debt to income ratio. And again, because they're looking at the bank statement and not the tax returns with depreciation, you're gonna get a much lower debt to income ratio. This is gonna allow then the buyer to qualify for a much higher monthly mortgage payment. In that example that we were talking about, could have doubled the amount of home payment that they're willing to take on, maybe even more. Now, a couple things about this. Down payment requirements for this are kind of all over the board with these types of programs. When things are good, the market's going great, rates are low, there's no foreclosures, the down payment could be only 5 to 10%, but when things are worse, minimum down payments tend to be closer to 20% on this. And then one final thing is rates will be higher on this loan typically than a Fannie Mae and Freddie Mac loan because we cannot sell the loan off to Fannie Mae and Freddie Mac in this. This is non-traditional underwriting rules. Watch this video for more if you need a refresher on that. But guys, that's the gist of it. This can really be the difference between somebody getting in a home or not if they're self-employed. It's a fantastic secondary option for someone to use that owns a business or is a 1099. And guys, thank you for watching and please stay tuned for the next video. Like, comment, subscribe, and share this with somebody. If you know somebody that runs a business, let them know about this little trick that we can use to help them get into a home with. It would help them out a lot. Thank you.